Test, 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 audio. Lots of
You're
people
still
flooding
coming
in.
through loud and clear, Eric.
Thank you. Thank you. We'll get rolling in about 30 seconds. A few hundred people registered for this evening, and we'll get rolling in just a second. I think this is now our third financial trifecta.
I think it is. I'm scrolling down through the list of attendees, and I see some repeat attendees.
Aha, some repeat offenders.
They're either slow learners or they're testing whether we're consistent or not.
Perfect. All right. Well, let's kick things off, ladies and gentlemen. And yes, this is our third financial trifecta. Interestingly, from the one end of 2020 to then the one in 2022 to now to the end of 2023, it's like we've been in three different worlds. Since then, there are two established and incredible presenters here. It's been an absolute joy with each. It's one of our most attended webinars of the year. It is definitely one of the most viewed afterwards, because if there's one thing we can all agree is, how do we pay less tax? How do we give less to the landlord? And how do we help sell our practice for the maximum amount? And when we started, rates were as close to zero as they can. Right now, suddenly, look at what's changed, let alone global pandemic and beyond. So, first of all, doctors, welcome for us, and also some great promotions and great opportunities, which brings me to our second speaker tonight, which is Andrea Chan. Andrea runs the Markham branch for MNP and is the newest board member for MNP. Andrea, thank you so much for joining us and always giving us practical tips and tricks and examples so we start to pay less unnecessary tax to the government. Perfect. Welcome, Andrea. And of course, Bill Henderson, as the former owner and senior transition consultant and broker for Tier 3, one of the true experts in the practice valuation wide world of sports, if you will, and no watching any sports on the background, even though the Leafs and others otherwise are playing for tonight. But Bill Henderson, really appreciate you joining, and always bringing some new key updates in terms of what's happening now in the crazy world of practice valuations and beyond.
What's changed since we were last together? So over to you.
Indeed, yeah, and maybe just to we're going to do an intro poll in a second, but maybe Bill, that's one of the top questions that we're going to dig into. But Bill, if you were to summarize over the past 12 months, what are you seeing in the market today? Maybe just to put you on the spot here, as you're talking to the doctor in the elevator, how would you briefly describe on what you're seeing today? And what I'll do in the meantime is pull up a quick intro poll.
Okay.
So give us a little sense. We're happy to customize some of the content here this evening, and there's a quick poll that'll pull up to give us a better sense in terms of your individual situation. But Bill, over to you.
So while I'm talking, everybody, click the questions. I think obviously you've referenced it already. Interest rates have close to tripled. Indeed, I should do the math. They may have tripled. I think they have more than tripled, because we were prime minus a quarter at 2.2 a year and a half ago, and we're up prime minus a quarter at 6.95 now. So yeah, my math says that's tripled. That has put downward pressure on the value of dental practices. If you've got a really good practice, the impact has been less than you might have thought, because we still are in a seller's market. But if you've got a practice with some issues, you're going to want to pay a lot of attention tonight, because you can recover lost value in a lot more, both in terms of the top line you're selling for, and if you listen carefully to Andrea, what you're going to keep after the transition. And then obviously, the world of DSOs, 1, 2, 3, and Dental Corp has gotten, well, let's just say they've retrenched a bit. And so if your plan doctor was to sell at the multiples they used to pay, that plan's gone and it ain't coming back. And we can talk more about that later. So hopefully I bought you time to get the poll answered, Eric.
Poll's up and running. Yes, thank you. Andrea, same question from your perspective. Tax, changes to tax, federal budgets, as well as overall tax planning strategies. And I know there's some great ones, and there's been some terrible examples where, the doctor now can't sell because of bad assets or because of delays, and doesn't want to pull the pin on these unfortunate, massive taxable obligations without the planning. But Andrea, just from a high level, what have you noticed over the past 12 months since we've had our last in terms of change, markets, clients, and quick overall summary?
Yeah, so I mean, over the past 12 months, it's interesting because I think there still continues to be challenges with having enough time to plan and be able to essentially take advantage of all of the tax planning options that are available when you're selling. But I think what's really changed over the last year is CRA is really cracking down on lots of different types of tax planning that not that they were traditionally used, but that they were being used more and more. And they didn't like it for obvious reasons. And we're seeing that some of those plans, and we'll go over that later on today, are being shut down. And this being the last year that you can do some of this planning. So it's becoming even like more important than ever that if you haven't been having a conversation with your accountant, you have to, right? Because this is the last go at the can, if you will. And of course, when plans shut down, there's going to be more that come up. So it's not like, all is lost, but I think, where plans are going away, it's always good to try and see if it makes sense to do now before it goes away. So, timing is everything. And now more than ever with all of the costs, tax rates, interest rates, et cetera, being so high, like every dollar that you can save is worthwhile. So.
Perfect. Great. So let's jump in. Just for relevance, roughly 80% are in a lease, 21% own their space. We'll touch on that on all sides from all three. Vast, but 8% looking to plan or open a practice, 52% planning to sell within the next 5 years. So that's our Bill, that's your target. 84. 21% planning to stay put, right? Plan for eventual retirement, renegotiate the lease, and a bunch for educational purposes here, lease, which we'll touch on, and incorporation, Andrea, 96% incorporated. From that, for those that are incorporated, what type of assets you have in your corporation, which we'll touch on. Cash, 83%, investments, 62%, life insurance, as I do as well, I must admit, 45%, right? And real estate, 30%, as the last few are trickling in. In terms of cash needs, Andrea, from a tax planning perspective, roughly 9% going back and forth need more than $350,000 per year. 41% would like to pay off the mortgage ASAP, right? 19% like to buy a secondary property, help fund kids' education / first house. In the GTA in Toronto is 22%. And kids' education, kids' homes, same thing, 25% large cash needs. Other large cash needs over the next 2 years. And then in terms of planning to upgrade by investing in the below, click all that apply, roughly 39% IT and services, which is perfect timing, Andrea, based on some of the changes coming through. Digital X-ray, 18%, 3D printer, 12%, milling, 3%. Oh, not good for Sarah. Scanning and lasers, 45%, practice management software, 15%. And Bill, 79% have not had a practice valuation in the last 2 years. 21% have. Perfect. Excellent. Okay. Thank you. So that's, again, we'll adjust and reflect accordingly. What are we talking about tonight? How do we help to keep more money in our pockets, keep less going out to landlords, right? The government, right? As well as to just losing valuation through the practice sale. So how do we drive margins? How do we help take money out of our corps more tax effectively? How do we help to make sure that the practice sale doesn't die at the 11th hour because of the stupid office lease and the landlord, right? And then also, more importantly, how do we help to make sure that we've mitigated our risk and any post-sale liabilities as we move forward? So again, if this is your first Cirrus webinar, welcome. We bring in great speakers and great opportunities to, again, help protect ourselves against the unknown and leveraging what the heck has been going on in the world. We're 29 years in the business. We're the only healthcare specialized tenant advisory and lease negotiation firm of our kind, and we're now 13,000 office lease negotiations. Quick market update. If you haven't seen it lately, rental rates, vacancies, comp report. Great article on the front page of the Globe saying that, especially looking at some of the major centers, especially Toronto and the commercial office space, it has never been a better time to be a tenant since 1994, based on vacancies in the market today. A lot of these, accounting firms, law firms, etc., are working remotely and are not coming back. So some of these big towers downtown are 50% vacant in some cases. It's truly astonishing. So what does that mean for you? Well, depending on where you are in the part of the country, lots of change in terms of rental rates, vacancies, right, months on market, and what landlords are doing now. But many landlords, especially those with heavy debt obligations, right, get themselves into a scenario where if they can secure a long-term tenancy with a VIP client like yourself, right, many landlords, especially those with high vacancies, are jumping those opportunities. Retail, ground floor retail, right, less affected than the commercial side, but it has created a significant shift throughout the entire country, especially for those commercial spaces, which again gives great added leverage for yourself as you're planning for your eventual transition. The lease. Why the heck do we need a lease? Why do we have a lease? And beyond. Also, we have the Q&A open. As a reminder, there's always great questions for practice valuations, lease issues, and tax issues. Feel free to throw that in the Q&A. And also, I know Andrea is interested, what province you're coming in from. So feel free to throw that into the notes as well. So briefly, the lease, and I'll defer to Andrea and Bill to reiterate from their perspectives why the lease is important, how it impacts the practice sale, and also the practice sale valuation. But ultimately, look, you are the best tenants, doctors on the planet. You have the highest build-out costs, upwards of $300, $350 per square foot to build out a clinic today. I kid you not. If you haven't done it recently, incredible value and cost, right? Number two, you have the lowest default rates at less than 0.5% likelihood you won't be there within the first 10 years of your lease, right? A restaurant, from comparison these days, even pre-COVID numbers, are over 92% default rates. What does that mean, right? That ultimately means that you are COVID-proof, you can't work from home, you bring in high quality foot traffic, and you have more leverage than you realize, especially as you're renewing your leases. I talked to a doctor today, try to do it on their own, etc., their renewal, and the landlord ended up sneaking in demolition, right, as well as limiting the actual term, and the doctor had actually missed his option to renew deadline date. So there was 2 of his remaining 5-year options that, because that date was missed, those options became null and void. Now there's no legal right to stay in the space, right, after 2025. So as it pertains to this, the focus is on the sale. Now, for the 21% of you, 24% that own, so the net of this here is you're not excluded from this section, right? Go get a glass of wine, but come back fast, because the lease is just as important for you as it may be for the tenant. And this is more so if you do plan, or there may be a potential to keep the practice, sell it separately. And if you're going to sell that for $1 million or $2 or $3, right, then the important piece is if there is a chance that you'll be keeping your building as a passive form of income or rental income for yourself, your spouse, etc., then this gives you the importance of that office lease becomes very important. You want to have a clear delineation of expenses between, right, what is buying a new handpiece from Henry Schein as it is to fix the roof, right? That makes Andrea's life a lot easier, as well as it makes Bill's life a lot easier from a valuation perspective by having two very distinct entities with separate expenses and a very clear lease that, if audited or otherwise, based on current fair market rents, right, and a clear delineation between the two. Again, heaven forbid, if anything were to happen to you, there were some devastating examples that came across our radar and desk through COVID where the doctor had passed away. And one devastating example, only one of his 3 locations were able to be sold because the doctor wasn't paying himself rent. And if it was sort of a true up at the end of the year. It wasn't based on market rents. So when, unfortunately, the doctor had passed away, right, then suddenly, if it doesn't sell within the first typically 90 days, it doesn't sell at all. But in this particular case, the associate said, well, we'll buy it, but hang on a second. Through the due diligence, they realized, well, I don't really agree with the financials because, rent is now lower. We don't want to buy the building. We just want the practice. So in the eventuality, 2 of those locations were unable to be sold. So how do we prepare for ourselves? Well, the importance of having a dental specific lease for your own building is very helpful for getting your buyer's loan approved, for example, getting your own loan approved if you're about to buy a building. If audit or otherwise, very nice to have a background supporting information of here is my lease, here is how I've been paying between pocket 1 to pocket 2. And then also here are examples of recent fair market rent, as well as liability slips and falls, delineating between the two, and then also helping to make sure that we've maximized the value of the asset of the building and certainly the value of the practice. I'll pause there. Bill, anything else to add, or Andrea, anything else to the 24% that are practice owners or building owners?
Not building owners. I mean, building owners, you have what most buyers want, provided, and here's the big key, provided the building's not too expensive to justify it as the location to operate the practice. If some of you out there have a smallish and declining practice in a office building in downtown Vancouver or Toronto, you're probably not selling your practice because the cost of buying that building is prohibitively high given the economics of the practice. So you need to be talking to somebody about, okay, am I going to be selling my practice or my patient base? Because often in those situations, you'll make a lot more money selling the real estate as real estate and the practice as the patient base. Those of you who have leases, the number one problem we run into selling practices is your lease. And if you've got some of these things that you've heard of, like we say demo clauses, but demolition's a big commitment on part of the landlord. They all have renovation in there. And that could drop the value of your practice $400,000 right out of the gate. So listen carefully when Eric talks about what they can do. Andrea, any accounting issues there?
Yeah, I think when you own a building, I think sometimes people make the mistake of trying to save costs by putting everything in one corporation, right? To build your point about flexibility later on when you're figuring out what to do about selling your practice versus selling the building versus both, etc. Structuring where you buy everything matters, and that happens in the beginning. And so, make sure you understand what those options are before you jump in and pick the lowest cost option possible, because it has implications for the future.
Exactly. Perfect. All key components, and that's key, right? Also, the last thing, again, if you own your building, think about it from the fact that if for whatever reason the associate things change, or they don't want the debt load of both buying the $1 million practice and buying the $1 million or $500,000 unit or condo strata, etc. Right? But maybe want a right to purchase or a right of first refusal, or lots of different ways of structuring that.
Yeah,
Bill mentioned
absolutely.
a few of these: demolition and relocation, the 2 CE courses we did last week with Michael Kuttner, major merger and acquisition attorney here in Ontario, also Paul Martin, Wilmington Law, big litigator on the employment side, specifically dental, last week, as well as Barb Jones at Tier 3. The number one question we had is, what the heck do we do with these demolition relocation provisions? So by definition, these do give the landlord the ability to, right, lack of a better word, kick you out, tear up the lease. In some cases with as little as 6 or 4 months worth of notice, and demolish, or just wake up on the wrong side of the bed and say, I'm thinking of redeveloping. And that gives massive concerns for the potential buyer, and more importantly, the bank, who is now bankrolling the $1 million to $1.5 million. Relocation, similar but different. Relocation provisions basically give the landlord the right to move you to any other location within the mall, or as Bill mentioned just prior to the webinar, one of the big components that in many cases it was to any other building that the landlord owned across the country. And one was Newfoundland, Bill, just in case the doctor wanted
And
to
the
get
other
relocated.
was Victoria.
So
Landlord was going to pay for it, though.
love it. I'd love to see that in reality. But that's the key component. Well, what happens if you're a doctor in Ontario or Newfoundland, and I mean, as silly as it sounds, if contractually they can, then that only becomes an issue if we were then advising the buyer to these components. Bill, anything else to add in terms of the big clauses that again can dramatically impact the valuation or the sale?
Yeah, and I just let me elaborate for a split second on demolition clauses, because people will often say to me, Bill, there's no way my landlord's demolishing this building. And I will say, you're probably right. But take a careful look. Does it say substantial renovation? There's a real obvious definition of what demolition means. Eric, you can correct me if I'm wrong, but there's no legal definition of substantial renovation. So if that's there and the landlord wants you out or wants to squeeze you for more rent, they can use it. The other huge issue, everything on your list here has got merit, but the other big issue is the assignment provision, because when you sell your practice, the assignment provision governs your obligations during that sale process and after that sale process. Two quick ones. We had one landlord insist that the tenant pay 5% of the selling price of their practice as the real cost of transferring the lease. And another one, we had the landlord insisting the tenant would remain on the hook in perpetuity through all subsequent lease renewals if any future tenant should fail to pay their rent. So I'll hand it back to you, because I know you have points of view on those, Eric.
No, look, Bill, this is, if the vast majority are thinking of selling, these are the type of things, and quite frankly, very different from looking at it from starting your first lease. But these are the critical components that, look, it's only as material as what you're dealing with on a daily basis. And yes, Bill's correct. There are more and more landlords in your assignment clause, if you're following along with your lease, that look for the word consideration, which basically states that if you, doctor, right, in conjunction with the assignment of the lease, selling from you, seller, to Dr. Smith, buyer, are receiving any sort of additional cash, right, goods, services, etc., in exchange for the transfer of the lease, then yes, many landlords, including some on the cover sheets, as Bill and I were talking on, just to ask to sell, are looking for 5% of whatever the money you're getting in conjunction with the sale. Or in some cases, I had one the other day that was the landlord required a check for $160,000 to just sign the lease, to transfer it over. Why? Because in these unusual times, If landlords can find a way to say, look, what's your practice worth without my keys, right, is a dramatic, important component to ensure that the lease is properly structured. With that being said, in the essence of time, this is a great one for doing a quick screenshot on, or there'll be a quick poll that we can do a follow-up. But again, make sure to track in your phone, when does your lease expire? What is your option to renew date? Are there personal guarantees? And as Bill mentioned, over 90% of leases that haven't been negotiated previously, the landlord will be put in there as standard language that you will remain personally and continually liable even after you've sold. And Bill's correct, right? Typically that runs until in perpetuity with no end date. Demolition relocation is a big one. It's workable. What do we do with those? Well, again, there can be a blackout period. There can be rewritten a dozen different ways to make sure it doesn't just whenever the landlord wants. Brand new plazas built and high rises have a demolition clause in it even before there's a shovel in the ground. These are just the things to prepare for. I mentioned this a little bit before. Andrea will touch on it, but again, how do we help? Who owns the building? Who owns the practice, right? Are you paying yourself rent? And this is a great piece to get how much nicer is it to say, look, I am the landlord. This is the lease that I've been paying myself, and transfer it to the buyer, right, as a simple assignment upon sale, right? Versus, hey, the ink is still wet. Here's a brand new lease, Mr. Buyer. And, suddenly now we're negotiating rent at the same time as you're negotiating purchase price. Much easier to get it out of the way beforehand. The big ones here, right? Financial terms, personal guarantees, death and disability assignment, consideration, and even surrender. So one practical example before passing it through to Andrea here is this one clause, the option to renew. This is what the doctor I spoke to today had missed, right? So look here for any red flags. Really three, right? Number one is this: be cautious. This is where a lot of landlords get very creative, but the options become personal to you. So provided that Dr. Joe Black shall remain as the tenant, and if duly is regularly paid its rent, performs its covenants, etc., not been in default, has the ability to renew the lease. That does nothing for Dr. Jill Smith that might be looking to acquire your practice. So you might think you have a 10-year term and 2 5-year options, but if it's only personal to you, it does not do any sort of favor. So making sure that your options are transferable, your ideally exclusivity is transferable. That's a nice bonus for Bill. It's part of the valuation. Hey, look, you're exclusively the only GP practice, right? As well as a death and disability that can be transferable. If not, they typically remain personal to the original tenant. Number two, and this is a bad one, and it just gets hidden away. Let me see if my laser works here. But when it says here, right, any such renewal shall be on the landlord's then current standard form lease, right? Which essentially means that, right, you, the landlord, can, whatever you negotiated last time, can come up with whatever new piece of paper with whatever new demolition or relocation clause and erode everything you did 5 or 10 years prior. The other one that can impact the sale and valuation, as Barb Johns was sharing a little bit last week at our last CE course in Mississauga and Richmond Hill, was in no event shall it be less than rent paid in the last year of the original term, which means that it's only going up and up and up. Right? And in some cases on the renewal, right, that lease can be incredibly important, especially if it can't reset, if it doesn't have arbitration or otherwise, or if it states that it'll go up to a higher rate, right? It doesn't help matters any. So one little clause can have significant impact. This is one that a doctor pre-COVID had what he thought was a great relationship with his landlord. and golfing buddies, you name it. The doctor built out a beautiful clinic, did a 5-year term. At the end of the first renewal, right, figured, oh, I got a 5-year term with 3 5-year options. I'm set, right? Put it back of mind. Then 4.5 years in, got this letter. As you know, your lease expires November 14th. Pursuant to section 2.04 of your lease, you had an option to renew the lease for 5 years at market rate. However, you were required to give me written notice of your intention to renew by not later than 6 months prior to the expiration of your term. By the way, this was May 1st. By my, shortly after, a couple of days after. By my calculations, you're required to give us written notice no later than May 14th of 2018, which you did not do. Please be advised that my broker will be placing a for lease sign in a conspicuous but non-intrusive place, right, on the premises this week. And oh, by the way, right, he will only show the premises to prospective tenants during business hours. Boy, is that lovely to have suddenly you chairside, and now suddenly the landlord is bringing in other tenants and dentists to walk through and show your space. So don't miss those deadlines. Relocations are another big clause. Landlords are going to ask for all sorts of components, but you want to think about what the heck happens if they do exercise their right to move you to any other location. What happens if you're shut down, right? What happens if the rent or the space is bigger or smaller? What if it's a pie shape and you can only fit in 3 operatories, not the 5 you have today, right? And again, in some cases, there can be termination components if you don't agree or comply within the certain period of time. Just one of the many red flags. We've got lots of other key components. In the essence of time, again, we'll do lots of Q&A as we go. If there's questions that crop up, we can handle them if they're on target. If not, we'll touch base with them after. One of the things here, I know there were some questions about twofold, is if you are, an appreciation from everyone's time, if you're concerned or curious as to what's within the lease, as mentioned, if you're curious about rental rates, updated demographic reports, we can see a ton of data now for the vast majority of the country. So if you're curious about what's hidden in your lease, right, or you haven't had it reviewed recently, or more importantly, if there was anything that might have been snuck into a previous renewal, highly recommend of just getting a quick update in terms of what rental rates look like for you, right? What demographics might look like for growth for your potential buyer, and then also obviously reviewing your lease. On that note, it is my privilege and honor to find out how the heck we stop paying so much in tax in this country of ours, and try, with the government poking holes and plugging holes everywhere, right? How, Andrea, do we stay ahead of this, and how do we make sure that we don't miss any good opportunities to make an investment and not miss any of these tax strategies to get ahead of ourselves? And you should have full control now, Andrea.
Awesome. Thank you so much. And forgive me if you hear my dog barking in the background, because I mean, he's normally barky, but this past weekend he got sprayed by a skunk, and now everything that moves in the dark, he's barking at. So yes. Lovely.
Tomato sauce, or tomatoes.
He's a fluffy white dog, Eric.
As the former Procter & Gamble guy, I'll tell you, Scope works great and smells better than tomato sauce after a day, but your dog may look a little green.
And no, we did have a cameo of Bill's dog on our first financial trifecta. But that's
right. I'll call Misha when it's my turn.
Okay, so I'm going to start with a really brief intro on MNP, and we'll talk about some of the challenges we're seeing in the dental market today. A lot of it's affected by the economy, and we'll go over some practical solutions, hopefully, on how to get ahead in this challenging environment. Okay, so at MNP, we have a specialized team across the country, from coast to coast, and we're dedicated to helping dentists with planning through the various stages of their career. And of course, as accountants, we do the typical things like preparing financial statements and tax returns, but a lot of our time is spent on tax planning, and we'll be sharing some of those tips today, and helping our clients buy and selling their practices, set up their new practice, structuring their corporations, and really just being a resource of their career. And I feel really, really fortunate to know Bill and Eric, because I know we send a lot of clients their way because they are so fantastic. Not only helping me with my dog and the smell. So this slide is a little depressing, I have to say. Like, all of you would have seen what's happening in terms of what's happening in the world. One being rising interest rates. There's no shortage of news around this. And, over the last year and a half-ish, it's really tripled, right? From just under 2.5% to now 7.2% at prime rate. It's the highest over 22 years. Everyone with debt is impacted, and a lot of people have debt. So whether it's, you have a dental practice loan, lines of credits, mortgages, etc. Many of, our clients are having to deal with the real impact of higher interest payments. And as you know, part of the reason why interest rates keep rising is the Bank of Canada is trying to control high inflation. And unfortunately, what that also means that you're seeing the impact of inflation in your increasing costs. So you're getting hit on multiple fronts, whether it be running your practice or just, you're running your household, right? Everything just costs more. Again, these are all real impacts on cash flows. And, whenever we're speaking to our dental clients, what has always been true, so it's nothing new. Staffing is always an issue, always, and this continues to be an issue, whether it be, a struggle with finding the appropriate staff at various levels, whether it be, an associate, hygienist, assistants, receptionist, etc. Having somebody with experience. And then on top of that, because it's such a competitive market, and we're seeing that in the accounting world as well, because it's so competitive, salary costs continue to climb, right? And salaries being the biggest expense for any dental practice, this has significant impact on cash flows. And then finally, in my world, tax rates in Canada continue to be high, right? It's over 50%. I'm not sure what the mix is across the country here, but in Ontario, the top tax bracket, the rate is 53.5%. It's very, very high. There's no expectation of those rates coming down. In fact, like I mentioned earlier, the government continues to find avenues to shut down certain types of tax planning. And there's massive increase in audits. You would have all heard about, all of the hiring of more auditors, which means, it's stressful for you owning a practice, having a corporation, and that there's more incidents of audits that you have to respond to, and then ultimately potentially having to pay tax back. And with all of these things, ultimately leaves you with less money if you keep everything status quo. So there's no real way of sugarcoating it. I don't think I did, other than admitting it is a challenging environment, and more challenging than ever that you're practicing in. Thankfully, there are some solutions that help you manage your money better, reduce costs, save taxes, and we'll go over some of those today. Big themes, there are government grants that are available, and we'll highlight one of them. The importance of regular tax planning becomes, more important than ever. And then, finally, how to minimize tax when you eventually sell your practice. So government grant. So the government grant that we're going through today is called the CDAP program, which stands for the Canadian Digital Adoption Program. Hopefully I got that right. And what that is the federal government recently introduced this to basically try to encourage small and medium-sized businesses in Canada to innovate with technology and to improve their businesses with technology. So if you meet certain requirements, this grant essentially gives you $15,000 towards a digital study to put together a technology roadmap for your practice, which should help you run your practice more efficiently. And this is, government money that's given to you. And essentially, to qualify for the grant, you have to have a practice, whether it's incorporated or unincorporated. You have to have at least one employee and up to 499 employees, which is a lot. So most dental practices would fit that. and at least $500,000 in billings in the last 3 years. Again, these are criteria that most dental practices should meet.
And is there any time limitation? Is this one that changes at the end of the year, Andrea, or is this one that?
No, I think you still have about 1.5 years, so you still have a bit of time. Being mindful, good question. Being mindful that by the time you apply for the grant, you do the analysis, and you get essentially what you need to apply for a loan, which we'll go over. It's probably about a 3 or 4 month process. So it's not one of those things that you want to wait. And you do want to do it before you buy anything. So time is important if you want to take advantage of this program. But it's not super pressing. What is super pressing is the next slide, where you have the ability to essentially write off your the purchase of this equipment and 100% of it, and this ends this year. So somewhat timely, yeah. So like I said, in terms of what it involves, right? Like first you have to go online and apply for the grant, which somebody can help you with. And once you get approval, you essentially have to meet with an approved vendor. So the government's picky about who you're choosing to do a digital study. So, you can't just go to anybody to get it done. You can't do it yourself. You essentially have to go through an approved vendor to put together a digital study. So at MNP, we do have a digital advisory team. That's not me, because I'm not technologically savvy at all. And the digital advisory team at MNP is on the approved list, which makes it very easy for our clients, and we just introduce them. And then after spending time with you through an interview process, and sometimes it takes quite a bit of time getting to know you, what you want, the digital advisor essentially puts together a report that details how you can improve your practice using technology. And then included in this report usually is either like a list of essentially, equipment, software, or time that you need to invest in to essentially, improve your practice in that way. You can use that list essentially like of equipment that you need to buy, as an example, to get access to an interest-free loan from BDC for 6 years. And this is where it piques a lot of people's interest, quite frankly. And the loan can either be $100,000 or $50,000, depending on your practice revenue. And so $5 million. If you're $5 million and below, you get $50,000. And if you're over $5 million, that you get $100,000 in loan. I mean, that's where, we're in an environment where interest rates are 7.2%, right? Being able to get a 0% loan is huge. If you're planning on buying a new scanner anyways, or a new x-ray machine, building a new website, etc., you can save a ton of money just from an interest-free loan. I know many of you said in the poll that you're planning on making some of these digital investments anyways. So, it's a nice way of, instead of using cash, right? Because you can use cash for other things. You can get an interest-free loan and fund that purchase, which saves you money over a 6-year span, which is fantastic. And of course, for some of our clients, the digital study itself is beneficial in helping you figure out, how to run your practice more efficiently. Someone with a digital background is coming up with a plan with you, to be more efficient. And, in an environment where we spoke about finding staffing being very difficult, right? If you can be more efficient and therefore needing less people, that, perhaps it can help you with the staffing issue as well. I know for a lot of my dental clients, the conversation usually looks something like this. I'm looking to upgrade my office anyways, right? And should I go to a bank for a loan, or should I use cash? And this is where we bring up some options, whether it's using the CDAP grant, right? To essentially, if you're thinking about upgrading your office anyways, is there a more efficient way of doing it? Number one. And then, secondly, if you're looking to try to fund this piece of equipment or these purchases, is there a better way of doing it, i.e. using a 0% interest-free loan, which is huge. You don't see that very often. And what's really interesting is for some of our clients with multiple practices, right? So you might have 2 PCs, 3 PCs. This grant and these loans are available per corporation. So it can be very, very powerful when you have a group of practices that you're running or investing in.
One quick
Andrea, we had
question.
one person. Oh, go ahead, Eric.
I was just going to try to cover one live as we went, but the quick question from Dr. J was, new
Is it
practices,
available?
as long as it's 3 years, I'm assuming, or
Yeah.
and then can it be used for equipment?
Yeah, so that's a good question. So when you look at a new practice, it depends because you need 3 years of history, right? And one of those years you had to have $500,000 of revenue. So if it's actually a brand new practice, new corporation with no history, it's like you're not going to meet that, right? So if I mean, being a little bit more creative, let's just say sometimes when people build, like if you're building out an office, right? If like you don't equip every op, right? You might leave one just plumbed, right? That if you can stage that and have 1 year's worth, let's say you're able to hit the $500,000 mark in year one, right? And I mean, we're squishing the time here, right? Because you want to be mindful that you get this grant available and done before the deadline. But if you have that maybe in year two, that's when you equip the last office, something like that, right? So you can be a little more creative potentially with a new practice.
Okay.
But yeah, great question.
Again, good question. I see Bill's been answering some questions as we go. Feel free to throw them in, and we'll have a Q&A section towards the end.
Well. Okay.
Great.
Awesome. And then I guess to tack on to that, if you're able to buy the equipment, right, before the end of the year, before this year, so I guess, Eric, to your point about whether or not it's timely, you do get to expense it right away. So typically, before having this temporary expensing, I think I skipped a slide. There you go. Before having this temporary immediate deduction opportunity, like let's say if you bought a laser for say $100,000, right? You typically would have had to write that off over a 10-year span, which means you get the deduction over a 10-year span. You pay less tax over a 10-year span, right? With this temporary relief measure, essentially, if you buy the laser before the end of this year, right, before December 2023, then you get to write off the entire $100,000 this year, which means a tax reduction right away in this year. Whereas like if you buy it, even in January of 2024, like one day after, right, the immediate expensing rule goes away and you go back to having to write it off over 10 years, right? And getting the tax back now is powerful because you can use that extra money, to pay off debt faster or invest it, right? Like at least it's in your pocket. So good reason why you might want to buy it now if it's in a fairly short time frame anyways. Now, not everything is eligible for the immediate expensing rule. What is eligible is the purchase of any dental equipment, furniture, leaseholds, computer software, right? Up to a total of $1.5 million. There is a cap, but again, given the fact that the benefit ends in 2023, if you're planning on upgrading or buying equipment for your practice in the near future, this is a good year to do it.
Yeah, just one comment, Andrea, from a tax standpoint. If somebody waits until next year to do it, and Eric, I think you said roughly 50% of the people are planning on selling in the next 5 years.
Yes.
If they buy it this year, who gets 100% of the tax savings? And if they buy it next year, are they handing a whole bunch of the tax savings over to the future owner of their practice?
Smart, Bill. Exactly. That is
it was a leading question.
That is a smart point. Exactly it. Yeah. If you can do it this year, you keep those benefits to yourself as a potential seller. So really, really, lots of good reasons why you would do it. Now, again, when we're talking about rising, costs, mortgage rates, inflation, housing prices, etc., we know that the cost of running a household, simply taking care of your family and your kids, is more expensive than ever. And what we're finding, with rising property prices, and everyone is seeing that, most of our clients, if they want their kids to own property, they're essentially having to help them buy their first property to get them in the market. So regular tax planning is, has always been important, but, in today's environment, looking at how to take out money more tax effectively from your corporation is definitely very, very important. So every year, your accountant really should be coming up with a plan which lays out how you take out money on a regular basis. Usually, keeping it simple, it's either some form of salary or dividend or combination of both, right? There's nothing super complicated about it other than you have to understand the differences. So, and maybe it's taking out capital dividends, which are tax-free, but you have to be in a certain situation to be able to do that. But, depending on the plan that you work with your accountant with, there are very, very different consequences. So for example, if you like saving for retirement traditionally through RSPs or CPP, you need to take a salary, right? And if you don't like CPP at all as part of having to contribute to it, and you want more flexibility in terms of how to take out money, maybe dividend is a better route, right? Again, the nice thing about a salary or dividend mix is that you can change your mind and update the plan whenever you like, right? So for us, whenever we put together the financial statements and tax returns for the year, we also put together the plan for the upcoming year in terms of how to take out money so that, you know how to take out the money and how it's going to impact you for tax purposes, and ultimately minimize the surprises, right? Because we find that, a surprise tax bill is never nice, right? And so, when you have a plan, then you know exactly what to expect. And also, when you do things ahead of time, it gives you the opportunity to plan and figure out different ways of saving taxes if you know ahead of time what you are looking at. And typical questions like we would ask every year are, how much do you need in terms of money this year? Are there any big expenses coming up? What does your tax situation of your family members look like? Do you care about CPP, RSPs, etc.? And again, all of this is to figure out, what the right remuneration mix is for you, right? And usually the plan looks different every year, quite frankly, depending on your situation, because of your situation changes, because there's changes in tax rates, or there's just new government legislation. So it should be updated pretty regularly. Now, you realize very quickly when you take out enough money, and in Ontario, if you take out over $235,000 in income personally, you end up paying 53.5% tax for every dollar that you take out. So, in an environment where it's more and more expensive to run your life, understanding that there's other tax planning ideas that you can use to reduce your personal tax rate is super important. One example of that type of planning is the capital gains plan, where it essentially converts what would otherwise be a salary or dividend into a capital gain. And when you compare those tax rates, using a capital gains plan can essentially give you up to 20% in tax savings, which is huge, right? It does require, restructuring and basically reorganization of your corporations and lots of legal documentation and tax filings. So, when we have a conversation around with our clients around whether this plan is for them, we always go through the exercise of, okay, this is your situation, this is your potential tax savings, versus this is the cost of running this plan, what are the risks, etc., to help them figure out whether or not this plan makes sense for them, right? Sometimes it's not just about the cost, sometimes it's the risk, etc. So, every person is different. I think our job is to make sure that our clients know what the options are so that they can choose what the best plan is for them. I mean, some examples of conversations we've had with lots and lots of our clients recently, because this plan is getting shut down this year. So this is the last chance. So therefore, like the volume of conversations are just, skyrocketing because this is the last shot. So I spoke to one of our dental clients the other day, and they were talking about how much they need to run their household every year. And this particular person needed about $250,000 after tax, right, to fund their life. They are the sole income earner in the family. And when you look at like the traditional types of planning, if you're going to take out $250,000 net in your hands, and let's just say you take it out through a salary, you need a salary of about $460,000 a year. So over 3 years, that means you're taking out almost $1.4 million in salaries, paying $630,000 in tax to get that $250 a year, or $750 over 3 years. Now, if we did a capital gains plan, right, this is the comparison, right? If you did a capital gains plan, instead over 1 year. So you're going to take the income in one shot to get 3 years worth of spending. So the 750, right? So 250 times 3. You would only need to take out just over $1 million, right? Which means that you pay about $275,000-ish in tax compared to 630, which is like the traditional way of taking money out. Another way of looking at it is if you take out $1 million in dividend in one shot, this is probably a better, more fair comparison, right? You would end up paying $500,000 in tax compared to 275, which is the capital gains plan, right? So by doing capital gains plan, you save this particular person $225,000 in tax. It's huge, right, for their family. And I know, in the poll, there's like a portion of you that needed $350 a year, which is more than this person, this particular dentist. For you, I think it's definitely worthwhile to look at as a potential tax savings vehicle, because it could amount to quite a bit. Another client that has 3 kids, and they're all like grown, but like everybody else, it's very, very difficult to get into the real estate market. So very generously, they said that they wanted to help their 3 kids buy their first house, and they wanted to be fair. So regardless of how much the house cost, they wanted to give every child $500,000 to kickstart their housing purchases, which is very generous.
Are they looking to adopt any new kids?
I know, right? Me first, Bill. Me first.
You just bought a house, Bill. Come on.
So again, in this situation, we compared what it would look like if we took out a dividend. And when you take out a dividend, it's about a 50% tax rate, so very expensive. So to get $1.5 million out, you need $3 million to do that with, right? If you did a capital gains plan instead, you only need 2.05 million, right? So almost $1 million less. You pay, $550,000 in tax to get 1.5 million net. So you basically need $1 million less, right, in order to get the same money out. Like, it's a powerful, powerful plan, right? I know some of you would have said in the poll that, you want to pay off your mortgage ASAP, help your kids, or you have a big spend coming up. This is something similar, right? That situation when you have a big lump sum, a capital gains plan works very, very well in that instance. I mean, I know a common a question we get is, why don't you just do this plan regularly when the tax savings are so substantial, right? And the reason is the tax savings is a function of how much money you need, so it depends on the person, and it does require a tax reorg, right? Which means it's time consuming to do, right? There's a lot of legal and accounting, which means it costs money, right? So when that happens, you would only do it if it makes sense. So again, because we're expecting that CRE is going to shut it down this year. If you're thinking about this type of planning, very important to go through the pros and cons exercise of whether or not it makes sense for you. And if it does, this is the year to do it. And I would say that because everybody is looking at it, you probably don't want to wait till December before you look at it, because I mean, quite frankly, in terms of the order of steps, your accountant needs to go through everything, put together the plan. Then they need to give it to a lawyer, right, to paper it all. And all of those things take time, and you leave it till the last minute, you're probably not going to be able to get it done. You're going to have people say no, right, in terms of executing the plan. So just be careful. And, of course, there's other types of tax planning which involve insurance. I'm not going to go through that in too much detail. It's complicated. It can work really, really well. Again, I think, if you're thinking about any sort of more advanced tax planning and even regular planning, quite frankly, you just want to make sure that the person that you're using has a tax team behind them, right? And they understand the details and can implement the plan properly. We've seen a lot of cases where clients have come over or their previous accountant used the template, they plugged in some numbers, I mean, quite frankly, the plan just didn't work, right? And obviously you're in a situation where you're put in a ton of risk. So just make sure you don't put yourself in that situation. So really, if you think you're paying too much tax when you're looking at different options, I think, this is a great time to look at what those options are and see what makes sense for you. Now, I'm not going to go through this in too much detail. I know, in the survey, the majority of you, over 90%, I think, were already incorporated. So you obviously understand the reasons behind incorporating. We talked about it briefly in terms of when you own a building, right, for your practice. What we typically see is you own it in a separate company to keep the two, your dental practice and the building separate for flexibility. I mean, frankly, to get HST back, and you get faster leasehold write-offs, etc. So there's tax reasons to do it as well. Lots and lots of good reasons. You just have to be careful about fair market value rent and all of that, right? It's where you bring in your accountant to help you. But also, when you think about more complicated structures, whether it's hygiene companies, holding companies, et cetera, what we always say is whenever you make, you create more structures, it gets more expensive. So you always want to make sure that you're picking the simplest structure that works for you. And if you're adding something, that there's a reason to add it. So don't add something just because your friends have it, right? Hygiene companies are very specific and they're used for very specific reasons. Holdcos, associate PCs, etc. for purifications are very specific. So you do it when it makes sense. So just make sure that you go through those exercises. And again, your accountant can help you with that. So when you sell your practice and, with Bill's help, you're going to get a great price for it. We know that. We've seen the work that he does, which then also means, unfortunately, a large sum of money in one shot that has to be included in income. So if you don't do anything, you're going to end up paying a lot of tax. And when you're selling a practice, if you sell shares of your professional corporation, this is what everybody's trying to achieve because it gives you the ability to use the lifetime capital gains exemption, which is essentially you get to use about $970,000 of capital gains per shareholder tax-free. And what that equates to is about $260,000 in tax savings per shareholder. So, for example, if you have a dental practice in your PC, and let's say your practice was worth $3 million, and you had yourself, your spouse, and your kid as a shareholder of that corporation, essentially you can use 3 capital gains exemptions, right? So 3 times 970, you don't shelter the whole 3 million, but very, very close. And you essentially save, at least $780,000 in tax. 780, oh my gosh, that's a lot of money, right? But again, it requires you to structure properly. And then more importantly that, there are rules that your PC and you personally have to meet. I'm not going to go over the personal rules, but the PC rules are important, and I want to go through some of those today. And really, the rules that you want to remember, all the important ones, all circle around 2 years, right? So the shareholders have to own shares for at least 2 years, and then 2 years before the sale, half of those assets have to be active, and then just before the sale, 90% of the assets have to be active. And what are those active assets? Active assets are essentially the practice assets and goodwill, right? So to the extent that you're doing well and you're saving money in the corporation, it essentially throws you offside with those rules fairly quickly, right? And those savings, if I give you an example, if you have $1 million practice, that's what it's worth. Once you get over $1 million in savings, which either mean cash, investments, loans to other companies, life insurance, real estate, which some of those were listed, you're offside with the 50% rule, right? So again, it's very, very important that you keep on side with those rules 2 years before the sale, because generally speaking, they're 2 years before, right? You have to meet that rule 2 years before. So if you want flexibility to sell the practice whenever you want, because you never know what life throws at you, you need to be on side with the 50% rule at any point in time. And to clean out a company and make it pure, we can do it tax effectively, which is commonly referred to as a purification, which is essentially moving out bad assets without triggering tax, right? If you're just going to take out all of the assets through a dividend and pay it, 50% in tax, that's kind of useless, right? So the key is that you want to move it out into another corporation tax-free. Where it gets tricky is when you have life insurance, real estate, et cetera, inside the corporation, because it can trigger tax for one, but also sometimes it's just difficult to get out. So common mistakes, we alluded to that all over the place. We see when people do buy life insurance inside their corp, buying life insurance in general inside a corporation is a great tax planning tool. Many of our clients have life insurance inside the corporation, but they typically buy it through a holding company, right? And And unfortunately, the issue when you have life insurance inside your professional corporation is that when you want to sell your practice, first of all, it's an inactive asset or a passive asset, which makes you offside with the rule. But secondly, no buyer is going to want to buy a practice with life insurance in it, right? The problem with moving life insurance out is that there's no ability to move it out tax-free. When you move out life insurance, if there's value, it's a 50%, 50% tax period. So, so for some people with very large life insurance plans, a lot of value inside the corporation, that can be problematic to move out. Maybe purification doesn't make sense, right? Another example is, let's pick on just properties in general. You know, if it's your practice property, let's just say when you want to sell your practice, you don't want to sell the building with it because you want to use that, you know, to continue to get cash flow for yourself, right? If you want to do that, then essentially you have to have it outside of your professional corporation when you sell. And if that's the case, you need it to be held elsewhere. Problem when you have a real estate inside a professional corp already, in order to move it out, you can move it out tax-free, so that's positive. But when you move it out, it triggers land transfer tax, right? So depending on where you are in the country, that can be quite expensive. It is a hit based on fair market value. So something to think about. I think if you have any of these assets inside your corporation, what's important to note is that it's not like everything is lost and now you can't use the capital gains exemption. That's not what we're saying at all. But the sooner that you deal with it, the less painful it might be, and the more options that you have. So make sure that you look at these sooner rather than later, because you can fix it. I'm not going to go over this in too much detail, but I think, just given the time, but I think, when you're thinking about sale planning, very generally, you want to look 10 years in advance if you can. 5 years is better. Absolute last minute planning is going to be 3 years because you want to have some time to meet those 2-year rules. So make sure you're reviewing your situation with an advisor in terms of, what your retirement goals are. How much money do you need? What does your structure look like? What do you need to clean up, etc.? And do that sooner rather than later. So just touching on retirement, because if you are able to sell your practice, congratulations. You are enjoying life. I think what we want to impart on you is that once you retire, tax planning doesn't stop. Right. In fact, it gets more complicated because it's different, right? Like you now have multiple pools of money that you have to draw on for retirement. And depending on how you're drawing up the money, where you're drawing it from, how much, etc., has different tax implications. And this money needs to last you for your lifetime, and potentially to have inheritance for your kids, etc., etc. So it's important to plan that out properly. And then finally, with estate planning, is always one of those tough conversations that a lot of people avoid. But as you're past retirement, most people are increasing in age. You have a lot more assets, et cetera, et cetera. So it's really more important than ever to work with your advisors to figure out what you want to do, with your money, how to, account for life changes, what happens, when you pass away in terms of tax implications, et cetera, are the things that you can do to mitigate that. Documenting everything, because, for anyone that's taking over an estate, we've seen that it can get really, really messy. And when you don't have the documentation and everyone's lost in terms of where you're supposed to go, it can be very stressful. So, make sure you get all of that in order. And on that note, I think I'm going to pass it on to Bill to teach us about how to increase the value of your practice.
Perfect. And you're muted, Bill, just in case the dog's in the background. But it's a great one. There was the great example that we did in Ottawa was two doctors. One sold a $2 million practice. The other one sold a $2 million practice. One with zero tax and one with hundreds of thousands of dollars of tax. So yes, the type of guidance you can get now, especially at least 2 years in advance, can be, another client, he's stuck. he doesn't want to bite the bullet and pay the hundreds of thousands of dollars, but he's getting pressure to sell. And again, some tax planning 2 years prior could have, allowed for an exit. Now it's, well, hey, do I keep going even though, right, I have this massive tax bill? So don't get stuck between that rock and a hard place, especially if health or anything else changes. So perfect, Bill. How do we help to protect? And is it a buyer's market or a seller's market? Everybody wants to know.
Yeah, I will cover that. The quick hit, if you've got a good practice, it's absolutely still a seller's market, where the buyers have a lot more leverage if you've got some issues. So I am just one person of an entire team we've got coast to coast across Canada. So while I'm Ontario-based, all of you listening out there, if you want some follow-up, just let me know, and I'll make sure we get one of our right team members working with you. Because what Andrea and Eric have described is it's a lot tougher now. Practices are harder to sell. They're not selling for what they were. The government's taking more of it. So what I want to talk a little bit about today, and then we can get, I want to be sensitive to time, so I'll let you ask your questions in the Q&A. You can type questions in now. We'll take them all at the end. But I do want to give you some ideas on what you can do to deal with that. It's one thing to say, oh, the sky's falling. I want to talk about how we keep the sky from falling on us. So I'm going to talk about, first of all, what determines the value of your practice. A little bit about what's happened to values over the last 2 to 5 years, but then I really want to focus on how you can make up the difference in terms of the value of your practice. Some of you out there will have a detailed definition of EBITDA, and we could get Andrea to go through it, but for some of you, it's still a mystery. Some of you will be thinking, this is how a practice gets valued. Somebody will add up the value of all of the tangible assets in my practice, the equipment, the leasehold improvements, and then they will put somehow magically they'll put a number on goodwill, and that'll come up with the value of the practice. The reality is that is not remotely how practices are valued today. It's not how buyers are buying. They can't repay their bank loan with the chair in Op 2. They can't fund their kids' college education with their goodwill. What they're using to repay their bank loan, fund their lifestyles, is income. So income is what's driving the value of your practice. And if you've got a good accountant, somebody like the woman on this call, you're paying them to help minimize your taxes. And so most of you will get a financial statement annually that includes a statement of profit and loss, or there are multiple names, but you'll recognize this. Here's an example for Dr. Pat Sample doing $1 million a year in revenue. And you can see on here all of the costs that they've got. But you don't pay, sorry, I went a bit too far forward there. You don't pay us to minimize your taxes. You pay us to truly reflect the value of your practice. So we'll take that income statement, and I'll just show you a couple of the quick changes we make to come up with the adjusted EBITDA. You are likely paying yourself and or your spouse and or your ne'er-do-well cousin or brother-in-law some money. That's not a real cost of operating the practice. So we add that back. In this case, it was $240,000. You are very legitimately writing off part of your car because you're driving to and from the lab and visiting patients at home and doing a bunch of those things. But it's not a real cost of operating the practice. The meals and entertainment that I'm sure are all with patients and referral sources aren't something the purchaser is going to factor into their economics. So we add those back. The trip to Vegas for that excellent conference is also not a real business expense. The next one surprises some people. Your license and fees, so your ODA fees or your BCDA fees, whatever you're paying your regulator for your license, is deemed to be a cost of being a dentist, not a cost of operating a practice. those of you who have associates, I'm sure, are not paying for their provincial association fees or their licenses. So we add that back. Amortization is a non-cash expense. That's writing off something you spent cash on a year or more ago, or maybe this year. That gets taken out. So does interest, because EBITDA stands for earnings before interest, taxes, depreciation, and amortization. So you can see we're adding back the amortization. Eric, is there a cool way I can get the laser pointer here? When I hit my mouse, it advances the slide. Don't worry, I'll describe it to people.
Try that, Bill. You should have it now.
Let me see. I can see it there. Oh yeah, there's a big time lag. That's what happens when you live in Stratford. It just, everything goes very slow here. So I'm not going to bother with that. So what you can see here is that whereas the dentist was claiming $860,000 in expenses, we've adjusted that downward by $335,000. But, and this is the key, this dentist is making about $525,000 before paying themselves. And when I talk about earnings multiples and say your practice should sell for a 5 to 6 times multiple, people will look at this and go, oh, I get it, Bill. I'm going to make $3 million when I sell my practice. No, because the multiple is applied to your adjusted EBITDA, which is after paying you to be the dentist in the practice. So in this case, the dentist is billing $630,000, 40% compensation at standard, even though I've misspelt compensation. I'll get that right next year, Eric. I think it was wrong 2 years ago as well. So the comp's 252, and the earnings from an adjusted EBITDA standpoint that would be used to value your practice are $223,000. I'm happy to walk through individually with people, individual cases, but you've got the picture. I'm going to be using Dr. Pat Sample's example coming up, and I've simplified it down to that chart you see on the right. But you can see we've got the adjusted EBITDA of $223,000 on revenue of $1 million. So how does a practice get valued? It's the EBITDA times an earnings multiple. It really isn't quite that simple because a purchaser may have very different expectations of EBITDA in the practice under their ownership versus yours. They may think it's going up or down. We use a range of tools to model EBITDA in terms of potential, and patient counts matter a lot. Age and quality of equipment matters too, as do the business trends. But for today's purposes, the way this Dr. Pat Sample's practice would be valued is that 223,000 times 6%, or sorry, 228 times 6 times earnings multiple. So this practice would be worth $1,037,000. The key thing is what just appeared on your screen. You do not control the earnings multiple your practice will sell for, other than some parameters around the terms of the sale. But in general, that's beyond your control. So if you want your practice to sell for more, what you need to focus on is the earnings in your practice. Now, my earlier slide talked about the mystery of EBITDA. I tend to think of this way of valuing practices as having incredible power once you understand it. Because when you realize that the value of your practice is being driven by earnings and applying a 5 to 7 or 8-fold multiple to those earnings, relatively smaller changes in your annual operation can yield a big difference in what your practice will sell for. So here's one example. If we were live, I'd ask people to raise their hands for how many people think if they really looked at it, they could build their hygiene program 15%. When I do that with live audiences, normally over half of the room does exactly what Eric's doing right now and raises their hand. So think of the impact of that. And it shows you on this little chart here. 15% increase in the hygiene program from 300,000 to 345. Now, you're going to incur a bit more hygiene costs, so we've upped the staff costs proportionately. But the EBITDA has gone from 228 to 250. So each year you're getting before tax $22,000 more out of your practice. But at a 6 times earnings multiple, you have increased the value of your practice by $130,000. And if you were paying attention to Andrea and follow on her suggestions, that could be entirely tax-free. So the big picture to take is relatively small changes can materially change your personal net worth. So with that as background as to how these things get valued, let's talk about the range we see in terms of earnings multiple. And I'm going to go back to 2021. We came out of COVID, and there was a very unusual thing that happened. Dental Corp went public and needed to show significant growth. Plus, 123 dentists and Ultimo, we're talking about merging, and they were going to get paid a 14 times earnings multiple when they merged. So if you traditionally, am I coming through okay with audio? My earpods are, I've taken one out so I can recharge one. Then I'll swap them around. So if you traditionally paid 8 to 9 times earnings multiples, but you knew you were about to cash out at 14, Eric, you're a smart man. Would you have paid 12 times multiple if you knew you were going to cash out 6 months later at 14? You might have even gone to 13 if you were competing with Andrea, who's smart. So we saw a one-time, completely anomalous leap forward in the prices that Dental Corp and 123 were paying. They will tell you the same thing I'm telling you. It was a one-time event. But it was a huge multiple you could get. It does come with some conditions. Generally, you're going to be looking at a 5-year commitment. You're going to be providing earnings guarantees, usually for that full 5 years. And a portion of the purchase price, depending upon the deal, was often in illiquid stock or stock that's publicly traded, but you can't release. But the 8 to 12 times was pretty damn good, especially when, if you were selling to an individual buyer, it was sort of 6.5 to 7. And if you had a challenging practice, or some of you aren't located in big urban centers, if you've got a small little practice in a remote rural area, you might have been down in the 4 to 6 times range. But we're not there now, Dorothy. We're not in Kansas anymore. The DSOs now are consistently down in the 7 to 8 times range. If any of you have heard a recent credible source that they're above that, let me know. But they're telling us, and we're selling to them, this is exactly where they're at. Private buyers are down to about 6.5 times for good practices, and challenging practices or remote practices, you may be down in the 3.5 to 5.5 range. So what that means, if you were planning on selling to a DSO, your practice today is probably worth 20% less than it was 2 years ago. If you were have challenges in your practice and things like demo clauses and lease problems, not having enough term, that can put you in that category. You're probably down 15 to 20%. The biggest reason is this. Prime rate has gone from 2.45 to 7.25. Now, dentists are getting money at prime minus a quarter. So it's gone from 2.2 to 6.95. Now, you can look at that in the context of history and go, hey, that's not that anomalous. But look at the impact on the cash flow for somebody looking to buy a practice. This shows a practice, what a loan would have cost a buyer in January 2022. Prime was 2.45. They were borrowing at 2.2, but nobody thought it was staying down that low. So banks were consistently sensitizing or testing loans to make sure people could repay them at a higher rate. Several of the banks back in January of 2022 were using 4.5%. Now, sensitizing a loan for $1 million at 4.5%, amortized over 12 years, principal repayments, 83 grand a year. The interest would be 43 grand in year one. So the loan repayment would be 126.5. So you needed that much cash coming out of the practice after paying, a buyer would need that much cash coming out of the practice after paying for their lifestyle expenses in order to get a loan for $1 million. Now look where we're at today. The prime rate 7.2, people are borrowing at 6.95. The banks aren't thinking we're seeing a big jump from here, but they're generally sensitizing around 7.25. So if all I had was that 126.5 you see at the bottom, in terms of my ability to repay, because that's all the cash flow that was coming out of the practice, at that interest rate, all I can afford is an $827,000 loan, because that's all the cash I've got to repay a loan. That is a 15 to 20% drop in purchasing power. Now, Andrea, you were being very direct with people. I have been, but I do have a good news story.
We have seen that drop in what the DSOs are. We've definitely seen similar drops in what private buyers. We have not seen it for good practices from private. Generally, we're
percent range. And the reason for that is that if I went back and showed you, well, we're paying 40% to the dentist, dentists to get a good practice are investing some of that money and not taking it home. They're using it to pay down their loan and get a bigger loan. So the market has shifted back towards private buyers. So those of you out there who are looking to buy a practice, you're in much better shape today, even though those interest rates are high. Andrea covered this stuff really well, some of the things going on out there in the marketplace. Let's talk about how it impacts practice values, though. Staff shortages mean you can't bill what you used to bill. So that's got pressure on your revenue. Staff shortages are driving wages up. I don't have to tell you what your assistants and receptionists, and especially your hygienists, are coming to you in terms of, well, I can get paid this over at that practice. So that is driving your costs up. Supply and equipment inflation is driving your costs up. And then I've just talked about the DSO retrenchment. Those rising interest rates are hurting the multiple. So the big question is, what can you do about it? And we've all seen this quote before. It's hard to get where you're going if you don't know where you're starting from. Andrea was talking about getting started 3 years in advance. I would suggest 5 to 10 if you want to really get to where you want to go. We and a number of our very worthy competitors will do a practice appraisal for you that'll tell you where you're starting from. But if that's all you're getting, you're not getting your money's worth. We should be identifying ways to build that value and the appeal in your practice. So I'm going to show you, go through these quickly so that we get to Q&A. I already gave you this example up front. One of the things we do, every appraisal we do, is we look at where your hygiene program ranks. This shows hygiene billings per patient per year across 200 odd practices. This is a specific client of mine. She was in Ontario, so I'm comparing her to the Ontario provincial average. It varies a bit based on fee guides. You can see she was down in the bottom 10%, billing $161 per hygiene patient per year. She had no idea. and most of you don't know how you compare. The challenge with that, which is all we used to give people, is it tells you what the problem is, but not really diagnosing it at a deep enough level. So now what we're doing and what we did for her, I'm going to skip past that because there was a name there, actually. That's my bad. But what we're doing is we're benchmarking how many units of scaling you're doing per patient per year. And we're looking at your patient's real and actual recall frequency, not what you think they're doing. And those usually are very eye-opening. And in terms of identifying ways of building hygiene programs, and here's the example I showed you of a 15% increase, it's very rare that we don't find ways people can build their hygiene program, which I love because I come at it from a business standpoint, but you're all clinicians delivering healthcare. And I know, because I talk to dentists all the time about this, most of you would agree that a significant proportion of your patients would benefit, their health would benefit from more frequent hygiene appointments. So it's the easiest and, I believe, best way to build practice value. The next thing is patient base. And, you know, all of you will say, yeah, well, duh, Bill, building my patient base is a no-brainer. Most of you know how many, some of you know how many patients you have. Many of you know how many you're getting new because you're seeing them. And it's not too hard to track that on a monthly basis. Very few of you, in my experience, virtually none, know how many you're losing each year. You know how much water you're pouring into the top of the bucket. You may know how much water's in the bucket, but you don't know how much is leaking at the bottom. So every appraisal we do, we look at your total patient base or count for the last 3 years. And it's simple math. If I know your total patients and your new patients, figuring out how many you've lost is a simple subtraction exercise. And many of you would be very surprised by this number. Those of you who are tracking attrition only by requests for record transfers are probably missing half of it. So let's for a second say, and the other principle here is, and it's true in any business, it is far easier to keep a client or a patient than it is to attract a new patient or client. Far less expensive. So plugging the hole in your bucket, if you've got one, and understanding it, can yield huge benefit. The example I just showed you, I'll go back a second here. That dentist is running about 12% annual attrition. If they got that from 12 down to 10 in 5 years, that's a 10% increase in value of the practice. And you can see we've increased hygiene, dentistry, lab 10%, staff costs are up, doctor's comp is up because he or she is doing more dentistry. It's a $190,000 increase in the practice value by reducing attrition by 2% a year. Supply costs, very similar thing. If this practice was running a 9% supply cost, could be down around 7.5. Getting down there would be a $90,000 improvement. And I wanted to tie back to Andrea's conversation about digital. This is something that you all need to take a careful look at. Dental Corp and 123 are, and you're competing with them. The things like digital impressions are going to save staff time, both doing impressions, sending them off to the lab, you yelling at the staff when the lab case isn't back before the patient appointment. Patients love the convenience of digital, and those of you who only 3 of you are interested in in-house crown milling. I plan on changing that in 2 slides. But let's begin by looking at clear aligners. Digital technology allows you to deliver clear aligners to your patients. That's new incremental revenue. This is 18 cases a year at a below average $5,000 cost. they're expensive. Your lab costs will go up a bunch. But still, the earnings in this practice, with 18 clear aligner cases a year, go from 200, call it 230 to 263. Look at the increase in your personal net worth. Don't think of it just as an increase in value. It's an increase in your personal net worth. And this is why I believe many of you, if you've got a lab bill 70 grand or more, should look at in-house crown milling again for the first time. The technology has changed massively. I know people who had CERIC or Plan Mecca, hated it, got away from it. It's gathering dust over in the corner in their office. The new technology with the AI they've got built into it is getting real positive reviews from people who've gone with it. And look at the impact on the value of $1 million practice that had lab spending of 70 grand. If you brought 70% of that in-house net of the cost of the blocks you're milling, which probably means you need to bring about 80% of the lab in-house. And even though you're paying for a little bit more staff time if you've got your assistant planning the crown, your earnings could go up by 50 grand. And at a 6 times multiple, you get it by now, right? That's the leverage or the power of EBITDA. So 3D printing night guards in your practice is also an opportunity. 8 night guards a month, 3D printed in-house, 110 grand, 8% increase in value. So these technologies that you can get interest-free loans for can make very significant changes to your personal net worth, make your practice more attractive. And the cool thing is, they're not mutually exclusive. So now I know many of you out there will be going, Bill, there's no way I'm ever doing clear aligners. I love my orthodontist. And that's totally legit. Others will be saying, nah, I don't care what you're telling me about CAD/CAM in-house. I'm never doing that again. Too bad an experience. So you don't have to do all of these things, but look at the impact if somebody did. We actually had a client we worked with about 3 or 4 years ago who literally built the value of their practice by $1.2 million. They started at $1.7 million, they sold for $2.9 million. So that's what a good practice valuation will give you. Now, a couple of last ones to wrap up. Eric, our host here, I could not go forward without saying that, and I said it already, leases are the single biggest problem we have selling practices. It's really important you have enough term on your lease. Because Eric, if somebody's had a 5-year term, they're 3 years into it, and they're going to the landlord to ask for a lease assignment, and the purchaser needs a 5-year additional extension, how's the landlord likely to react knowing they're standing between the purchaser, the vendor, and several $1 million?
They see dollar signs, right? And that's only 7 years. Most likely the bank's going to want the 12, right? Many national banks in Canada, if it's a 12-year payback period, they're going to want 12 years worth of term and options on the lease, right? And transferable options.
And I will end up advising you when your landlord hoses you for a massive rent increase to agree to that, to pay it, because otherwise you're not selling your practice. And the buyer is going to insist that they will pay less because their costs just went up. Their EBITDA just went down. So we didn't talk a lot about term earlier, very important. We talked demo, reno, relocation clauses, manageable assignment provisions. There are other legal issues you need to worry about. If you have an associate, they must have an enforceable contract. All the time, not all the time, but 5 times a year, I run into a dentist that says, Bill, my associate's my best friend. There's absolutely no issue. They'll be happy to sign an agreement. And I say, okay, let's get them to do that before we sell the practice. Because the moment they know that they stand between you and a sale, they're going to go, but wait, I contributed to the goodwill here. I should get part of this. So definitely make sure you've got enforceable contracts. If you've got older staff contracts, there was in the employment law world, an earth-shaking precedent back in 2020 called the Waxdale precedent. Make sure your employee contracts are compliant with that. And then I hope you were listening to Andrea. And if this is the other biggest mistake we see, people who have too much money in their corporation to sell it or didn't get family members in. And you know, the question's simple. And we get people who tragically have died without being incorporated. Dead men and women can't incorporate. We get people who died with too much money in their corporation, and your provincial regulator will require you to sell the practice quickly. Generally, you'll get 6 months. That's not enough time to qualify for that 50% rule Andrea was talking about. So your choice is pretty simple. Would you like to keep an extra 270, 540, depends on how many capital gains exemptions you've got, or would you prefer to send it to those pretty good-looking guys on the right of your screen? Your call. But if you don't know your fine from a tax standpoint, make sure you're dealing with an accountant who can help you there. The question always comes up, so I'll preempt it. Getting a proper practice appraisal shouldn't just be a number. It should be much more detail around what I just went through quickly. We do them from as little as $4,900 with future updates for $1,500. Different appraisers do very different work and their fees will vary. So I'll leave you with this last image, which is if you've been paying attention today, that number could be a lot bigger than 500,000. And if you're like me, it's kind of nice having a bit more in retirement when I get there. Eric, back to you.
Perfect. Well, we've got Q&A. We've got amazing content. I think every single doctor is stuck with us through all the Excel spreadsheets and numbers and analytics. And I can't believe, Bill, you've had more numbers on the screen than the accountant has.
It is how I built and differentiated the brokerage I bought. Andrea would, I know, agree with that. And I went through that super fast because I wanted to get to Q&A. Hopefully people got the principle, and anyone who wants a bit more detail, frankly, anyone who wants a copy of my presentation, just email me. And we'll get you looked after.
Indeed. And there's also, just to make it easy, we did a couple of questions here. Yes, for some help from Cirrus. Number 5 for some follow-up and a request for any information from MNP. And then number 6, obviously Bill and his national team for some follow-up. So made it easy, just a quick little yes, no, if you'd like some follow-up help, information, tax strategies, we can get connected to the right person in your neck of the Canadian woods. So on that note, we've had a bunch of questions. Andrea, I know you've done some private answers as well as Bill has as well. We've had some pretty colorful questions as well, I must say.
I see one of them there that I'm looking forward to answering.
Yeah, I know you are. Andrea, maybe just to kick us off. Andrea, any of the questions that might be applicable for all rather than sort of case specific?
I think in general, I mean, there are some questions about fees and stuff. I think it's interesting, right? Because I think whenever you throw out fees, right, without having any context, is always a little bit dangerous because we have no idea what your situation is, and certainly I don't think picking the cheapest option is the wisest option, but I think understanding what makes up that fee, why it is what it is, so that you're comfortable, like with whoever it is that you're working with, I think is prudent. And sometimes getting a second opinion is the way to go, right? Just so you can figure out, who you feel comfortable with, why the fee it is the way it is, and does it make sense for you? I think that's important. I know there's a lot of questions around CDAP. I think I answered it. What I will say, I think with the whole CDAP grant, because it's fairly new, so I'm not surprised there's questions, and sometimes things are quite case specific. For some of our clients, where, I mean, because I'm not the CDAP expert, like I said, right? For some of our clients who are even like just interested in the program, right? We can set up an intro call with the digital advisory team, and they can literally go through your situation and figure out like whether you qualify, and then do you want to do it? What does it involve, right? And then give you almost like a step-by-step playbook in terms of how to get the grant, and then where you go from there. So that might be a good way of seeing whether it makes sense for you, because we've had calls where like for our clients, it's like, oh, that was interesting, but it doesn't, like, you know, I'm not going to go through with it, which is totally fine. And then others that are like, oh, I didn't even realize I could buy this particular thing, right? With the interest-free loan. So that's like, it's always enlightening, I think, meeting with a group that actually specializes in the area.
Perfect. And back to one of the questions about fees, and I've wrestled with it as well, right? Accountant fees, lawyer fees, etc. And if it's $30,000 or $40,000, then typically it's worth it, but it's worth it based on your own situation. So leverage, right? Leverage Andrea to give it a secondary look type of thing. Make sure that it's prudent and aligned with your long-term strategies. And sure, look, if it's easy math, if it's 40 grand now to save $200,000 or $250,000 in tax, you know, that's simple math. But definitely get a second opinion. Or again, if your accountant isn't having these types of conversations with you about your transition, about minimizing tax, etc., definitely time to have an additional conversation. Same thing if you own multiple locations, right? What's that structure look like? What if you want to sell one rather than them all together? You know, how does that work? These are the type of things that it's much easier figuring out now early on than it is, right? If heaven forbid, you know, health or otherwise changed. Bill, you've had some other questions.
I just wanted to chime in on that because most of us will have heard the Oscar Wilde quote that a cynic is a man who knows the price of everything and the value of nothing. I think what both of you are talking about is, yeah, doing some of this stuff is very expensive. And I'm going to tie it back to Lisa's in a second as well. But you've got to look at the benefit you're going to get out of it. Is paying 40 grand to purify or 50 grand to purify your company so you save 250,000 in taxes? That, I know the price is high, but the value is huge, unless you wanted to send money to those three guys in the picture. And I see dentists making this mistake with their lease all the time. And Eric, I'm sure you come under pressure because it's easy to focus on the dollar per square foot number and whether it's fair and reasonable. And let me give you a simple example. If you've got a demo clause that's in effect now, your practice is worth $400,000, $500,000 less than it could be, because the bank's going to say to the buyer, hey, sure, the cash flow would pay for a loan for $2 million, but you could find out the day after you buy the practice that you've got to spend $500,000 moving that practice. So we're only loaning you $1.5 million. Thank you very much. So at that point, is spending an extra $4 or $5 a square foot, if that was enough of an inducement to the landlord, worth doing? Of course it is. Same thing in terms of getting your term extended. So I know Eric and his team are really good at focusing people on the big picture. So my message is all to all the dentists out there who will be inclined to go, oh yeah, but that's a 20% rent increase and that's unfair in today's market. It is unfair, but it's smart. So just keep those things in mind, both on the cost of some of the tax structuring and in your lease negotiations. So back to you.
Yeah, no, and Barb also mentioned these days as well that for a lot of the valuations, if there is a demolition or relocation in 3 years or 5 years from now, the reduction per square foot, Bill, I think is up from $250 to $300 per square foot. Is that correct?
Yeah, and we're now, I was talking to some contractors last week, and they're starting to say, hey, 300 to 400 now. It's the inflation point Andrea was making.
So in simple components, if you're looking at a practice, can be just pushing out that demolition clause a year or two. If you've got a $1.7, $1.8 million valued practice, just by pushing back that demolition clause a year or two can be hundreds of thousands of dollars of difference on Bill's valuations, and be discounted back or otherwise. But it is important that every inch counts, and starting to, a big takeaway through a lot of these questions that have come through start taking off, as difficult as it is, that doctor hat and coat, and put yourself looking at your lease and your business through the eyes of the buyer, right? That is the best way to help frame yourself now, and to look at the lease and exclusivity and term and options and continuity of revenue and any sort of improvements, etc. Right? It's very easy just to sort of run your practice and then, okay, hey, I'm out. But again, if you're looking at it through the eyes of the buyer and you're making those strategic investments and you've got the right, bulletproof lease, beautiful, right? Talk about those multiples of EBITDA. It just gives that huge level of comfort and differentiates your practice versus the one that down the street or even next door that has the relocation or demolition, right? And additional risk for that buyer that might be forced to move across the street at $400 a square foot, right? And then have to go back to the bank and say, whoops, right? I need another 400 grand just to solve my today problem.
Yeah. Well, the bank's going to review the lease before they loan money to the purchaser now. And everything comes to a screeching halt if they see demo, reno, or other. And it's not just, don't make the mistake out there of just looking at your lease and saying, I don't see the word demolition, because landlords have some pretty clever ways of building in termination provisions in spots that really don't make sense. There's a reason they use massively long paragraphs, incredibly complicated language, and right and left hand justify every paragraph, because technically that's much harder for people to read and more boring. They're trying to sneak all kinds of stuff past you. So get an expert, because it's as simple as this. Your business's right to exist is dependent upon tenancy certainty. And buyers and banks know that.
Bang on.
So I guess answer the question about selling to a DSO.
That's a good one. What's the value of the stock now? Needless to say, Andrea, lots of hand raisers for follow-up, so we'll get those to you. Bill as well, lots there. Again, we'll make sure, yes, there will be a recording available. Yes, give us some time, typically about 10 business days for the CE components. We truly appreciate everybody's time. We look forward to digging in a little deeper, helping to see how we can assist. And bottom line, you're not alone in any of this, guys. Just you've got lots of people here that are willing to spend some time to help you out and help you save. Certainly take them up on it. Appreciate everyone's time. Thank you so much for your extended evening. Andrea, your dog is still well behaved.
He was taken outside for a while.
Yeah, maybe a little V8 or tomato juice in there just to help. Same thing happened to my neighbor's dog twice. It's a bad year for skunks.
Oh my gosh.
Appreciate it. Bill, thank you so much. And
thank you, as always.
An absolute pleasure.
One comment, an anonymous attendee asked for some follow-up. If you're still on the call, you'll need to follow up directly because you show up as anonymous on our end.
Correct. So hopefully you fill out the polls as we go through.
Yeah.
Thank you so much, everybody. Looking forward to it, and have a fantastic evening and have a very profitable sale. Thanks, guys.
Bye, everyone.
Bye. Thanks again.
Thanks, guys.